Is securing a property for 400 or 500,000 amazing value because it's just so cheap? The answer is possibly. While you can secure amazing value properties, sometimes very cheaply, as your mum or your father would have said, cheap does not necessarily mean or equal value. And the performance you will see between a true value property and a low value cheap property can normally equal big dollars over the coming years. In this episode, I'm going to pull apart the difference between cheap and value, what I think value really looks like, and perhaps most importantly, what assets are showing strong value at the moment that are still relatively cheap.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
Let's get straight into it today and really understand what the difference between cheap and value is. Now, some of the best examples that we can give you are, for instance, cars. You might have that Toyota Hilux that you are paying for the badge and that reliability versus a lot of other cars that present significantly better value, which could be cheaper prices, jammed packed with a significant amount of instruments or significant amount of software or leather or whatever it may be. So you might find that in that particular case, a cheap car, much cheaper than, say, for instance, a Toyota Hilux that has a good track record and a substantial amount, for argument's sake, of goodies might be better valued than the more expensive car. So that's a really good example of where cheap is probably better than more valuable. So another example is, I'm sorry to put, Temu in this particular video or segment, but yeah, you may have bought those cheap products from Temu that cost you nothing or $1 or $2 and only to find out that, hey, within about 4 hours it's broken. It may have been better to spend $4 and you've got it now for a lifetime. So that is a very clear example of where cheap doesn't necessarily mean value. So I want to take this back to assets and properties, and I want to predominantly focus on properties because this is where I can share with you a lot of my experiences and how I determine what is cheap and what is value. Now, a lot of properties we've seen, and if you've watched some past videos, you would have seen where I've really discussed about that bottom end of the property market now starting to really creep up towards the middle end or almost be considered as the middle end of the market. And it's really to understand why and what's happening. So when I'm looking at properties that were cheap or are cheap, I'm looking at, well, what's inside of them? Are they below replacement value? And often you'll hear that replacement value means, well, if I was to buy this land and build that particular property on it in today's value, would I be spending substantially more? And if you're spending substantially more, that means that you're probably buying the property below replacement value, which could represent value in the future. Why? Because if someone today was to go buy a block of land and build a very similar house, yes, it's new, but a very similar house and spend $300,000 or $400,000 more than what you spent on an older property in relevantly good condition, well, then all of a sudden your price starts to really creep up because people start to look at the comparison of cheap versus value. Hey, I'm spending something brand new. I'm getting pretty much similar, yes, about 10 years, 15, 20 years newer, but nevertheless, I'm spending $400,000 on it extra compared to if I bought that older property and maybe spent $100,000 in renovating it, I could probably get a similar or very close product to something brand new. So that's where cheap does represent good value. And that's what you need to start to consider. So there needs to be a business plan when you're identifying cheap properties, cheap that are valuable and cheap that are not valuable. For argument's sake, if you look at properties in very regional areas of Australia and you're looking at them for $200,000 or $300,000, you've got to really ask yourself why they $200,000 or $300,000, and there could be reasons such as no economy in that space. Could be closing businesses, declining population. So you still need to make sure that you're doing all your due diligence and research, but focusing more on metropolitan areas or closer to metropolitan areas of major capital cities and major regional cities, that cheap versus value argument, you need to make sure that you're assessing that at all particular times. And I'll give you an example why. Now, my father often questions me every time that I buy properties, and I like to share what I'm buying with him. And that's just to get his personal opinion, because I do call him a bit of a negative Nancy, and he'll come up with 30 different reasons as to why I shouldn't buy it, but of which all valid, and I love to hear them so I know how I can mitigate them. Now, often he'll say, Jeremy, the price that you're spending, what's a property worth $100,000 more in terms of cost represent you in value? And that's where when I'm deciding on an area or deciding on a type of property I want to buy, I'll always look at something slightly more, about $100,000 more. And I'll look at a number of properties and compare them with properties that are about $100,000 less. What I'm looking for is the value that I'm gaining in those properties that I'm spending $100,000 more on. And what am I identifying? On those properties that I'm spending $100,000 more on, I could be getting a $100,000 pool. I could be getting an additional 50 grand worth of cabinetry that is not in the $100,000 less property. I could be getting an extra 50 square meters in land. I could be getting a wider frontage, a better side access, or potentially development potential. Now, in that particular case, spending that $100,000 more is going to give me maybe $200,000 or $300,000 additional value compared to the property that I'm spending $100,000 less on. So again, if you're really starting to look at your property search in 2025, I believe the year of value, then you need to make sure that you're looking at all ends of the spectrum and comparing properties, not just in the same price bracket, but looking at properties that are about $100,000 more. Because sometimes by spending that little bit extra, you'd be getting substantially better value. So it goes back to Temu versus, say, a much better quality Australian-made shop. And that is one of the key things that I'm constantly doing when I'm on the property hunt. I'm looking at replacement value, and am I buying this property below what I could buy the land and build it for today? That represents some good value to me. Number two, I'm looking at a slightly more expensive property versus the property price that I was reviewing, and I'm seeing what additional value that I'm getting. And in some circumstances, I actually see a substantially lesser value. So a property that's wanting $100,000 more, I may not be getting the 100 grand uplift in value. There's no pool, the kitchen's just as old, may have 10 square meters of additional land, but unusable. Same dimensions in terms of width, same side access. So for me, like for like, that $100,000 additional more expensive property is asking, from a value perspective, a hell of a lot more than that cheaper property. So identifying value amongst looking at properties that are relatively cheap versus properties that are relatively more expensive, and comparing the two to seeing what benefit you're receiving from a dollar perspective is very important. And that leads us on to, I suppose, segment number 3 of today. And it's what areas are going to be representing the best value. Now, again, if you've heard me in prior episodes, I've really discussed about middle markets converging with bottom end of markets, and top markets actually starting to slightly scale down. Now, when I start to compare top markets and middle markets, I'm actually seeing a decent price disparity. However, in saying that, those bottom end of the top markets have definitely now slid into the medium end or the middle end of that medium end market. So it's confusing. Stay with me and follow me as I talk about this. That bottom end of the market, and we'll go now to the bottom end of the market's risen so much that it's converging with the middle market. I believe the value in the bottom end is very hard to justify. I'm looking at properties in some regional areas of Australia and comparing them with properties in, say, some metropolitan areas of Australia, and to me, they're not far off each other. Now, as an investor, purely if I'm just drawing a paintbrush over all areas, if I'm looking at properties regional versus, say, properties that are metropolitan and they're both the same price point, I'm probably going to go for the metropolitan area. My opinion, my choice, that's what I would do, subject to my own due diligence and research. But that middle market that's kind of stayed stagnant, it hasn't really moved because interest rates have been a little bit higher for longer and cost of living pressures have still been up there for some time. If you look at that as a historical point of view compared to the lower market, there might be deemed some value there. But where do I see the true value in this market at the moment? That top end. Those properties that were worth $2 million and $2.2 and $2.3 million, I believe they've slid down quite a bit, more than what the media is definitely saying. And again, if you speak to agents in those areas, they'll tell you that the properties are becoming a little bit harder to sell. They're staying longer on the market, and they're not getting the velocity and the furiousness of the amount of offers that were getting offered at that particular time. So that means that it's a really good time to be a homeowner purchaser or home occupier purchaser, or even an investor looking in a space where there's not a lot of competition. That's the place where you want to be. That's where you're going to get the best discounts. And that's where potentially you're following, and again, I've said this many times, the old Warren Buffett mentality of being greedy when others are fearful and fearful when others are greedy. So I believe that top end of the market that slid down to the middle to top end of the middle market sector is going to represent the best value. Some of these properties that I'm seeing, I believe are 2, 3, 4, and even $500,000 below replacement value in today's numbers on the basis of the substantial cost increase that we've had in relation to the building sector. Those properties to me seem like they've got some growth in them in the years to come, because not many people like taking pay cuts. And if you look at builders, they're not necessarily going to have a cheaper price on building a property today compared to, say, 3 or 4 years from now. They're going to, if anything, slightly go up, at least with the movement of inflation. So top end, I believe, has got quite a bit of value in it if you've got the capital and the borrowing capacity to purchase there. That middle end of the market has stayed, in my personal opinion, quite stagnant. I believe there's some that may have dipped into the top end of the bottom market and some that's probably stayed the same, but I haven't seen the middle market converge at all with the top end. In fact, it's probably pulled a little bit more away. The bottom end of the market, guys, be very careful. That's where the danger can be in 2025 and some years gone on. We've seen a significant level of increase in that bottom end of the market. We've seen a substantial amount of investors all wanting to buy those cheaper priced properties. And I believe a lot of the purchase prices that people are paying are above replacement value, which means that it could be a pending bubble there, or there could be a little bit more to go, but then very stagnated period of time ahead of those people that have invested there in those markets. That's my personal opinion. Again, I do encourage you guys to make sure that you're chatting with your property professionals, your financial advisors, your accountants, your mentors. Make sure that you're doing your own data, research and analysis when you're looking at this. Speak to maybe quantity surveys if you really want to get a good understanding if a property that you're purchasing is far substantially below replacement value. They're the best people to put that or put you into a position to understand that. And I think that there's great opportunities, especially if you've got the capital and the capacity to do it. I hope you've taken quite a bit an understanding of what cheap and value means, how to understand the difference of a cheap property, which may have good value, or a cheap property you don't touch, and a property that might be slightly more expensive but presents substantially more value than a cheaper property. So paying less is not always best, but paying more is not also a score either. So it's important to make sure you're reviewing all those things which identify value. Make sure you're doing your comparisons with properties that are in the market of similar prices, and also looking at properties that are slightly below and slightly above to understand that sometimes paying $5, $10, or even $100,000 more if your budget allows for it may get you a significantly far superior investment, which is going to put you in a far better position for long-term capital growth. I'm Jeremy Iannuzzelli. That's what school should have taught you. Don't forget to hit that like and subscribe button if you're watching us on YouTube, or if you're listening to us on iTunes and Spotify. Follow us. I look forward to seeing you in our next episode. Thank you again.